Welcome back to the channel. Hope you enjoyed the 2022 Outlook videos. A lot of those are still relevant, so hopefully you're still watching those. I hope your 2022 is off to a great start. Already in the first week or so of the year, I've gotten a lot of questions about stocks and bonds moving in the same direction, portfolio diversification, so I thought it would be good to do a quick video on portfolios and how we build diversified portfolios as we kick off the new year. So, as we mentioned in our 2022 outlook, rising rates are causing a lot of things to happen differently in the investment landscape than has happened over the last, call it 10 or 20 years. Many investors have held portfolios predominantly consisting of stocks and bonds. You've heard of the classic 60-40 portfolio for many, many years. And the intention was that we have stocks and we want to own as many stocks as we can. They appreciate the most over the long term. And then we'll own some bonds to diversify away the risk. And that has made sense, especially since the early 2000s. Bonds have had negative correlations relative to stocks. So what that means is they move in opposite directions. So as stock prices have risen, bond prices have been flat or down a little bit. And then in periods of time when stock prices fall, bond prices have risen. And so that has provided less volatility for investors' portfolios, and that's been largely a good thing. However, this paradigm is beginning to change. Interest rates are low and they theoretically can't go below zero. And so there's not as much opportunity for rates to fall and drive up bond prices. Further correlations between stocks and bonds are starting to increase. They rose dramatically in the second half of 2021. And stocks and bonds are already moving in the same direction as we start out the year in 2022. So far, as of today, the S&P 500 index is down about 1.4% for the year. The Barclays Aggregate Bond Index is down about 1.3% for the year. So they're not moving in opposite directions, they're moving in the same direction. So that means if you've got a 60-40 portfolio, stocks and bonds, you're expecting those two things to offset, and that's not really happening. Large institutional investors have been working on this problem for years. It's not new. It may be new to you, maybe new to lots of retail investors, but it's not a new problem to solve. Institutions have been diversifying broadly beyond stocks and bonds into things like commodities, real assets, like real estate, infrastructure, even digital assets. You can read that, cryptocurrency, reinsurance, alternative credit. There's a lot more things that are even on the chart on the page. There are really as many different investment options as there are ways to spend money if you think about it in the context of the economy. So let's just talk about one of these examples, real assets. Real assets consist of investments in like agricultural land, real estate, infrastructure like water utilities, cell data towers, things like that. You can touch them. They a lot of times produce cash flow. Generally, they're physical things that you can see. And regardless of the economy, people need places to work. They need real estate. They need a place to live. They need food to eat. They need agricultural products. You need water to drink. You need that water utility infrastructure. And you even need mobile data. In 2021, it's almost a requirement, right? So from 6/30, so June of 1991 through June of 2021, the private real assets index generated annualized returns of 9.3% with a standard deviation of 3.1%. So pretty good amount of return, pretty low volatility. The US bond index, the Barclays Aggregate Bond Index, was 5.7% from a return perspective. So again, good returns with a 3.9% standard deviation. So real assets actually provided a smoother, sort of less volatile ride over that period of time from 1991 to 2021. The correlations between the 60-40 portfolio and those real assets that we're talking about were zero, so they were unrelated. So that means that as one side of your portfolio, your stocks and your bonds went up or down, the real assets might have been doing something different. So that's good from a diversification standpoint. So as always, past performance is not a perfect predictor of future results, and we don't want to get stuck there. But if the goal is to say, are there ways I can diversify my bond exposure to have lower risk in my portfolio, and have things that don't move together, that are not correlated, then real assets, I think, deserve real consideration. And that's only one example of the things that are on the pizza pie chart on the right-hand side of the screen. So there's lots of different opportunities to look at as you think about portfolio construction for the next 10 years. And it's important to consider all of the options that exist, not just stocks and bonds. We did a piece in the Learn section of our website on this topic. So if you want to check that out, we'll put a link to that below. And Happy New Year, and we'll see you soon.